This is level 1 of the CFA program, the topic on financial statement analysis, and the reading on an introduction to financial statement analysis. And this is truly an introduction. This reading provides us with some super basic stuff about financial accounting. I'm going to tell you a quick story, a quick personal story. When I was writing my dissertation chairman used to say to me, Jim, the more you know about derivative securities, the more you know about finance. And which was odd advice because my dissertation had nothing to do with derivative securities. However, I'm going to give that same advice to you guys. The more you know about financial statements and financial statement analysis, the better you're prepared to be a good financial analyst, to be a good wealth manager, to be a good risk manager, because the CFA Institute is not really interested in turning us into accountants, but it wants us to think like accountants. And the important thing I want you to get into your heads as we go through this first slide deck and then the rest of these financial statement analysis slide decks is that in order to be a good financial analyst and a good wealth manager, we need to understand financial statements. So we're gonna think like good financial analysts, but we have to realize that the basis is to think like good accountants. Now, clearly, in my opinion, that second LOS is by far the most important of any of these here. We'll talk about statement of financial position, comprehensive income, statements of equity, statements of cash flow. So the other LOSs kind of flow from that second one. And then as we move through the rest of the readings inside of this study session, we're going to dive into the details. What's that word that people are using these days? The granularity. We'll do all that stuff. So I want you to just kind of sit back. We're not going to get our calculators out. We're not going to do any calculations or computations, but kind of take a step back and say, all right, this is the first layer of foundation of our financial analyst house. Hopefully we're going to build it out of, solid rocks or stone or bricks or whatever it is that's not going to blow away, like straw or whatever it was, that old tale that we heard when we were little children. All right, so this first one, describe the roles. All right, so financial reporting provides information on a company's performance. It's financial position. So read these here along with me. Interim financial statements, audited financial statements, management discussion and analysis, which is probably going to be super important for us, and then additional disclosures. Then we'll go ahead and dive right into analyzing those financial statements. And what that's going to ultimately do is allow us as good financial analysts to make an estimate or make a prediction about the future performance of the company, which then translates into something like, oh, hey, this stock price is 100 today. Based on all of the financial reporting and the financial statement analysis that I have performed, I think that price in 6 months is going to be 120 if you find good news, or you think it's going to be 80 if you find bad news. Let me give you just another quick personal example here. Imagine taking a look at my balance sheet, say Jim's balance sheet from this year when Jim turned 60. You'd look at my financial statement and you'd see lots of assets over here, right? I have a house, I have cars, and I have a bunch of stuff in my house. I have retirement, I have investments, I have a bunch of assets. Over on the liability side, I don't have much. I have a little mortgage left over, no car payments, very few credit card payments, although I do have college tuition payments coming up, but who knows what those will be like. So my Jim 60-year-old financial statement is probably relatively strong, knock on wood. But if you were to look at my financial statement as a 25-year-old single individual who was thinking about going to graduate school to get a PhD, I had almost no assets. I had student loans, I had car loans, I had all sorts of stuff. And so that's the goal, is to take a look at the financial position of a company and determine, is it Jim when he's 25 or Jim when he's 60? All right, let's look at the two primary financial statements, we call these, I always refer to them as the balance sheet and the income statement, but they're also known by their more formal name, statement of financial position, which, and I'm going to go back to 1981 when I had my first financial accounting class. I remember my professor said, think of the balance sheet as an accountant getting his or her camera out. Can you see my camera here? Click, and taking a picture. A balance sheet is a picture of what the company owns, which are known as assets, versus what the company owes, which is the combination of the liabilities and the shareholders' equity. Compare that to the statement of comprehensive income. Now, this is what my professor did in 1981. Instead of clicking, the professor went like this. You guys, are you even old enough to know that, this is how the movie directors used to have to do their movies way, way back in the old days. So the income statement is like taking a moving picture over time period, say a year or a quarter. And the summation of this income statement is revenues, right? That's P times Q. We remember that from our economics readings. So we have all these revenues and then maybe some other income. We'll talk about that other income some other day. And then we subtract out the expenses and we get something called, hopefully, a positive result. We call that net income versus a net loss. And remember that in our corporate finance study sessions, and I say this over and over again throughout all of these slide decks, is that goal of the business, maximize shareholder wealth. How do firms do that? Well, there are a number of ways that they do that, but it's a beautiful illustration here in that bottom gray box. What firms try to do is they try to make something for pennies and sell it for dollars so that they have positive income. And I'm going to give you a little preview of what we're going to talk about in upcoming slide decks. But when a firm generates lots of net income, right, it must be doing well on the statement of comprehensive income. Well, that net income then flows back to the owner's equity portion of the balance sheet. And the goal of the business is to swell the equity portion of the balance sheet. How does that happen? Well, that happens by firms generating lots of revenue, right? P times Q. Well, how do they do a P times a Q? They try to appeal for the Q, the quantity sold. They try to appeal to as many people out there as possible, right? Increase the demand for their product line. And then the P, oh my gosh, the goal of the business is to develop brand name product lines so the firm has some influence and some ability to charge a higher price than its competition. And then, of course, on the expense side, what do we try to do? We try to minimize those expenses, and that's why we hire, logistics people, we hire supply chain people, we hire operations people, so that they can manufacture our product or our service at the lowest possible expense. So remember this: purpose of financial statements there, a picture and a movie of the activities of this firm, either on one day or over some time period. What's the goal of the business? The goal of the business is to get that balance sheet and the income statement to get bigger and bigger. Now, of course, what's important on the bottom right-hand side of that balance sheet is the statement of changes in equity. And notice what it tells us there in the slide. Provides information on the increase or decrease in owners' investments over time. So that's what we're doing, that swelling of the balance sheet. We call that retained earnings. Now, of course, the reading also talks about appealing to other shareholders. Firms can issue new shares of stock and they can increase that equity position on the right-hand side of the balance sheet. And then, of course, we get to my favorite financial statement, which I'm guessing will become your favorite financial statement as you learn more and more about this. And I'll talk at length about that in the readings, in future readings. Statement of changes in cash flow, sources and uses of cash. So we can divide these into 3 different types of classes. And look, these are great exam questions, right? The CFA Institute could give you a question stem and say, what kind of stuff does this relate to? And answer A is operating activities, investing, and financing activities. So there are 3 really good exam questions that you should be prepared for. So think about that cash flow from operating activities is exactly what I said just a few moments ago. Make something for pennies and sell it for dollars, right? Corporations and businesses have these product lines, whether it's a good or a service. And these are the cash flows that are generated from those product lines, from the operations of the business. Now notice down at the very bottom of A, it says, comma, and which determine net income. So I'm going to go back here and I'm going to say, of course, making something for pennies and selling it for dollars. There's net income. Now we'll call it a different kind of a net income. Think of it as maybe a margin. But what we're going to learn as we go through, especially our corporate finance readings, is that net income, while it's super important as we think like an accountant, our operating cash flow is going to be even more important. But hold that thought for another day. And then we have cash flows from investing activities. And here's the example that I give my students all the time, because students, college students, they eat lots and lots of peanut butter, or at least they tell me that they do. Oh, maybe 20 years or so ago, Procter & Gamble sold its Jiffy peanut butter product line to Smucker's. So what does that tell us there under B? These are associated with the acquisition and disposal of long-term assets. So let me go back here real quick. Look at the top. Number one, assets over there. They can be short-term assets. We kind of call those current assets. And then there can be long-term assets. And this is what we're referring to here. The machinery, the equipment, the technology, the buildings, all that stuff. And so what does a firm do over time? Well, it can buy more stuff, or it can sell some of its stuff, like Procter & Gamble did when it sold its Jiffy peanut butter product line. And then, of course, part C asks the question, how do we pay for all these assets over here? These companies spend huge amounts of capital, hundreds of millions of dollars, sometimes billions of dollars, in all of the necessary assets required to generate these product lines or services. So how do we pay for them? Well, if we issue a bond, we're going to have to pay an interest expense. If we sign a lease, we're going to have a lease expense. So financing activities are those associated with obtaining or repaying capital that's used by the company. Why are financial statement notes so important? All right, so this is what happens. You go back here and you look at cash flow statement, right? Balance sheet and income statement. And so all you're doing is you're looking at a bunch of numbers. Now, when we're done this series of slide decks, you'll know exactly what all those numbers mean and the underlying assumptions under which they were computed and estimated and calculated. But the numbers, the math, is not going to give you the complete story. So the executives and the board of directors, of course, and then the outside accountants, they come up with these things called financial statement notes that say something like, "Oh, here's a note. Here, let me go back here to my Jiffy peanut butter example." So. Acquisition and disposal. So we're disposing a long-term asset. And so what did Procter & Gamble get from Smucker's for the sale of that asset? Well, it could have gotten cash, and it did some. It could have gotten shares of stock, and it could have gotten bonds. I mean, it could have gotten gold coins. It could have gotten movie memorabilia. It could have gotten a Rembrandt painting. I mean, anything that you can use as a currency. Now, of course, Rembrandt paintings are probably not going to show up when companies sell their assets, although go back to Dennis Kozlowski and Tycho and our fabulous conversations on the agency conflict where he bought $25 million worth of artwork. So it may or may not show up in there, but probably not. But here's the point. So Jiffy peanut butter is going to have, and Smucker's is going to have a note that says something like, "Oh, by the way, we sold this asset and we got this. We got some gold coins, we got some cash, we got some shares of stock." And then somewhere embedded in that note is going to be even more details about the exact pricing, boy, what if there were some options involved? We'll learn about the Black-Scholes-Merton option pricing model, probably not till level 2, but that's going to be super, super important for us as we move through the CFA program. And so what does that first bullet point say? Basis of preparation, reporting currency, accounting policies, methods, and estimates. So this is all important supporting documentation. So financial statement notes, think of them as supporting documentation, and then supplementary information. And this one is probably just as important as the details on pricing in the note, but also on risks and contingencies. Maybe derivative security shows up here. And then somewhere in those financial notes, we're going to have an opinion about the management. And so the executives are going to say, you know what, this is why we did it, and this is how we did it, and this is what's going to happen now that we've done that. All right, so results of operations, planned capital expenditures, and future outlooks. Describe the objective of audits. And I will tell you another personal story. My auditing class back in the old days, in my undergraduate accounting days, was my least favorite class for a variety of reasons. But I have a super close friend who is a public accountant, has been doing it his whole life. And he used to tell me stories about when he would go into businesses to audit. And he would say, you know, I went into a shoe store and I went in and I had to count the number of shoes and say, oh, yes, they had an inventory of 12 shoes and I counted 12 shoes. And needless to say, he loved counting shoes because that's what accountants do. They love doing this stuff. All right, so what does that first point say? Obtain a reasonable assurance whether financial statements are free from material misstatement. So this independent accounting firm, this independent auditor is going to come in and count the number of shoes and make sure that the shoes are correct, that the laces are tied, that there's rubber on the bottom of the shoes, and that, you know, you could probably try them on and make sure that they actually work. You can do this for shoes, you can do this for software, you can do this for anything. So the auditor then comes back and says something like, you know what, I tried on all the shoes. I'm pretty sure that what the firm has told me about inventory, this is exactly what happens. All right, so what's that first one? To obtain reasonable assurance. We like that, but we need to make a report. We need to say something like, okay, there are standards out there for reporting the number of shoes in the warehouse, and this firm reported its inventory according to some governing body of accountants that are out there. And so there are different types of audit reports. So let's go start at the bottom, right? D, disclaimer of opinion. This means that the auditor is really not comfortable and maybe not able to issue an audit opinion for one reason or another. Maybe all the shoes were left-footed shoes. Maybe the shoes had no laces in them. Maybe they had holes in them. Maybe they were all size 20. So there was something in there that the auditor didn't like. Or maybe the firm didn't give complete access to the auditor. You know, maybe the firm sent the accountant over to the shoe warehouse, and when the auditor got over there, there was nothing over there but hats. So he couldn't perform that. All right, let's move up there. How about an adverse audit opinion? Oh boy. The financial statements materially depart from accounting standards and are not fairly presented. All right, this is called something, maybe misrepresentation, maybe lying, maybe something else. Those of you who are old enough ought to remember 1999, 2000, 2001. We had tons and tons of firms out there who were not quite fairly representing their asset base. Think Enron. Now, a qualified opinion, what happens under qualification is that probably most of the stuff out there has been reported according to fair and reasonable accounting standards, but there are exceptions. So look on the bottom right there under B, exception to the accounting standards. And so as you can imagine, the independent auditing firm, if they find one thing that's not appropriate, then they report it, of course. They say, oh yeah, all this other stuff is good, but over here, we're not quite sure about that. And then most firms want an unqualified audit opinion, which means, hey, you know what they told us in the financial statements, to the best of our ability, that's pretty much exactly what happens. And go ahead and read this from the board, from the independent public accounting firm. Notice down the bottom right, this is Price Waterhouse Coopers. So what does this say? I'll tell you what it says. You guys read that in the block of the top left, and I'll tell you what it means. It says, "Dear Mr. and Mrs. Shareholder and the Board of Directors, you're stewards of the shareholders and the bondholders' capital," right? The stewards. These are the executive leadership team. They've done everything that they're supposed to do according to our reasonable reputation as a public accounting firm and according to the rules that are out there. Notice that bottom sentence down there. What does it say? The accounting principles generally accepted in the United States. Now, of course, one of the ways that the executive leadership team can present accurate financial statements to the auditor and then to the investing public is to have a good system of internal controls. And so I am always of the opinion, and remember that we went through all that stuff for professional standards and ethics, and somewhere in those professional standards there was a line that says something like, hey, transparency, whatever's going on here inside the company, we need to tell people outside of the company. Now remember, the executive leadership team is probably not made up of those who have professional designations in accounting. And so they need to put together a team. So the quality internal control team is going to promote these internal controls so that all the reporting is accurate and reasonable and timely. Now, the flip side of that is that there are politicians out there who say, you know what? We love you as executives and leadership teams, and we trust you mostly, but we're going to pass some laws. And so the Sarbanes-Oxley Act is one of the many laws out there that says something like, you know what, you need to demonstrate that you have an internal control system that's consistent with producing some kind of output that's reliable and reasonable. And this act requires management to take responsibility, and you can read that right there. Nike is responsible for the information, and this goes back to probably Enron and some other companies in which the executives then were sued and they were convicted in a court of law, et cetera, et cetera. I bet you guys already know the answer to this. Besides financial statements, what else do analysts use? And the answer to that question is, well, anything that has some material information. And so companies, they not only put out annual reports, but they put out reports that are regular reports that may or may not be audited. They probably aren't. But nevertheless, good financial analysts will want a quarterly report or at least a semi-annual report, even if they don't have notes or even if they don't have any kind of qualified opinion, even if the auditor hasn't even looked at these things, because the financial analyst knows that sooner or later these are going to be audited. And if what the analyst looks at, quarter one and quarter two and quarter three, those aren't audited, but then, the annual report is audited, and, financial analysts can add quarter one, quarter two, quarter three. And if they don't add up after quarter four to whatever shows up on the financial statements, then that's probably not a good working relationship between the two. And then, of course, you guys know this, websites, press releases, conference calls, earnings announcements, and all sorts of external sources, not least of which is the monthly or quarterly reports that come out from the federal government. Now, one thing that I'll mention here before I go on to the next slide, notice the very two last words we have on this slide deck. And I think this is super important from a testing standpoint. Peer companies. Boy, it's a great exam question to say something like, all right, here's one company's balance sheet. Tell me what's on this, assets equals liabilities plus equity. So we know that from a previous slide. But then to be able to compare that to a peer company and say, all right, here's one company, here's another company. Tell me which one is Oh, I don't know. Better, is that a right word? Tell me which one is more accurate. That might be even a better question. So peer company. So always be worried about a benchmark. Always be worried about the competition throughout the CFA program. All right, how about steps in being a good financial analyst? So articulating the purpose and context of the analysis. So, I mean, this could be almost anything, but let's suppose that we're good financial analysts and a wealth manager in our firm comes to us and says, hey, that company over there, they manufacture motorcycles. They're issuing a bond. And one of the ratings agencies said that they think that bond is going to have a BBB rating. What say you? All right, so what are we doing? Purpose is we're going to go ahead and do our own evaluation of the default risk of that motorcycle company. What are we going to use? Well, we're going to, here, let me just go back here. We're going to use all that stuff, all right? And what do we hope to do? We hope to make a final report that says something like, all right, this is how much credit risk, this is how much default risk that the ratings agency says there is. We think it's this much, or we think it's this much, whatever it is. So then we go out and we collect all the data, we process the data, which means, and here's a great link between and among the readings here, we can use all sorts of great stuff. I mean, in its simplest form, we can perform a ratio analysis, we can perform some kind of comparative analysis between and among the competition, but we can use all of our quantitative methods tools. We can use correlation analysis, we can use regression analysis, multiple regression analysis, analysis of variance, time series, all that good stuff. And then we're going to analyze all of the output. And this is going to be the defining moment of our report. Once we analyze that output, we're going to say, you know what? We think the ratings agency is wrong. We think there's way more risk. So we tell this to the wealth manager when we develop and communicate conclusions and recommendations. We'll say, you know what? I'd be concerned if I would recommend this bond to all of my bondholders with this level of a return objective and this level of willingness and ability to take risk. And then, of course, we need to follow up because what do we know? We know that bond ratings change over time, and then we know that we are probably going to process new information. How about this? Suppose that when we started this deal that the ratings agencies, and say there are 3 or 4 of them, they all agreed on the rating. We disagreed with the rating, and then at somewhere in the next month or two, some investment banking firm starts trading credit default swaps on this company. So now we have more information, right? And we can go and look at the actual price of a credit default swap, which gives us even more information on the default risk and the probability of default of a company. And so this is really a cool LOS. I mean, it's tough at level 1 to ask this question, describe all the steps, because this lends itself to be like a level 3 thing, like, okay, here's a problem, go ahead and fix it. But you can imagine the Institute, picking and choosing between and among all of these steps and saying, okay, the financial analyst does this and this and this. Which step in the financial statement analysis framework would this have occurred? And then you would say, oh, that's data collection or communications or whatever. So there's a whole bunch of questions in this slide deck. And I think that takes us through all of our learning outcome statements. So focus on that second one, and then we'll talk at length about all of these other LOSs, because I think they're embedded in the next readings. Because remember, this is called an introduction. So thank you for watching, and good luck studying.